Oh man, Jackson Hole Symposium. Jerome Powell speech. Will he rug markets, or will he give us a clue that he may start his rate cutting cycle and start turning on that money printer again? Loads to get into right now. You can see markets here are feeling a little bit tentative, right? If you look at the traditional markets here, Nasdaq up slightly here, 0.6, S&P 0.4, but it's all going to come down to Jerome Powell. Bitcoin sitting here trying to hold 26,000, running into this EMA ribbon. Lots to play for, guys. Give me a hello in the chat. Let me know if you're present, and we'll get straight into this one. We will be jumping over to Jerome Powell's speech in the next kind of 5 or 6 minutes, but let's just set the tone first and understand where we're at here in the charts. Can you all hear me okay? Let me know in the chat if you can hear me okay. Let's also test that our television is working as well. Let's go check on our TV.
To be bigger influences on emerging markets than domestic politics.
Let me know if you guys could hear that okay on the television. And let's get into this chart. So you can see here, guys, on the chart here, we're running into our 4-hourly EMA ribbon, right? Bitcoin here on the 4-hourly was consolidating here, tried to stop the bleeding around 26. Had a little bit of a move up here the other day, which we monitored all the way up here to 26.8. But again, running into this EMA ribbon, right? So running into this EMA ribbon, and that's what's going to be the challenge right here for Bitcoin. Clearing this EMA ribbon, getting above 26.6. And it can happen today. Either two things are going to happen today. It's going to be quite clear. Jerome Powell's either going to give us a positive outlook. Remember, this is not an FOMC meeting. This is a Jackson Hole meeting. This happens once a year. They sit for 3 days. They debate. A lot of the best economists in the world get together and have a chat about what they're feeling in their jurisdictions. And then Jerome Powell gives a clue about what he's doing. Okay, you have to remember, this time last year, inflation was at about 8.2% going into the Jackson Hole meeting, right? So we are in a better place now, whether we like it or not, whether we feel it or not. We are in a better place than we were this time last year. So shout out to you guys who managed to invest through this period and hold on to your crypto, hold on to your coins despite this. Let's see what you guys are thinking in the comments. Give me a shout out, guys. Like, what are you thinking? Is it a rug pull? Are we going to have a pump? Put that in the chat. Is it going to be a rug pull? Is it going to be a pump? Shout out to Impatient Investor, good to see you. MJab, good to see you again. Special K, Abin, Niels, Coinmaster, Carlos, lots of familiar faces. Lloyd, Roger, good to see you. Gustavo, good to see you. Barry, cool. Bunch of you guys. Adam, of course, he's going to be hawkish. Why would he weaken the dollar? And this is what we now got to understand, right? Lots and lots of dynamics at play here, guys. I mean, you talk about the weakening of the dollar, right? We can see here dollar index is what's causing this pain. We know that. Dollar index having a crazy month or so here, this upward trend on this 4-hourly chart, this is what's causing the pain, right? So is he going to continue this? Is he going to continue to speak in a way which will strengthen the dollar and move this continue to the upside? If it does, it's going to be difficult for Bitcoin. It's going to be difficult for Bitcoin, but that means then we can start preparing ourselves for lower price points. You guys know I'm not ruling out 25. I'm not ruling out 24, and there's even lower price targets, right? If I switch you to my daily chart, you guys know the structure that I'm working with, right? This is the structure that I'm working with right now on the charts. You can see the first pivot point is where we're trying to bounce. Failing that, my next pivot point is down here at 20,000 flat. Failing that, we come to the bottom, 16.4, right? That's the structure I'm using right now in the charts. And again, if he comes out hawkish, with some of these price targets can start to come into place. You've got to have your game plan set and ready to go. Coinmaster thinks he's going to rug us. Abil Beck says, stop scaring people, man. It is long. Happy for you to go find another channel, buddy. You don't need to sit here watching Jackson Hole. I mean, if you're watching Jackson Hole, I think you're probably somebody who knows about the economy. So why don't you just listen to him and take it for how you want to take it. Justin, good to see you, buddy. Tech for Moo, good to see you. By the way, guys, just to let you know, there is a new channel, Ijaz Awan. I will be linking that up for you guys. I'll be posting on there tonight, the first video. It's going to be all stuff non-crypto. So if you care more about my journey, how I build businesses, how I have a stock portfolio as well, my wider thoughts on economy and things like that, and you know, kind of motivation and what advice I would give to youngsters as well trying to build wealth in this world right now, which we're living in, then definitely check out that other channel. More non-crypto content will go on that channel. Doesn't mean there won't be crypto content, it's just not going to be crypto TA. Crypto TA and these types of videos continue to remain here on this channel. Beyond Infinity, nice to see you live after so many days. Yes, good to see you, buddy. Always live when there's a CPI, if there's a bit of an FOMC, if there's a Jackson Hole speech, I will do a live. Otherwise, the normal TAs day to day would just come out in the normal fashion. Adil, salam, brother. Hope you are well. 22 to 24K says Ehsan. Stephen said, well said. Adil thinks 22 24K as well. Okay. MJab says, I'm thinking 28k to 30. Okay, so he's expecting a bounce here post-FOMC. Let's switch on over to our good friends over at Bloomberg to make sure we're getting the feed loud and clear.
You know, the headlines will come out here and Mr. McKee will warble gaily and away we go.
TK, I'll share this with you. 12 months ago, I raced off set to go to the bathroom.
I remember
Go to the restroom. And then I raced back again. I couldn't believe it was only 8 minutes long. There is a sense, Lisa, this is longer. It's more thoughtful. It's less just about inflation and much bigger themes. There is a hint from other people. I'm not sure where it's really come from. The neutral rate. Are we going to talk about R-star? I would suggest to take a guess that this has come about because the economic data has been so much stronger over the last several months or so that people are starting to have that discussion. They'd like him to have that discussion. Whether he chooses to have it 3 minutes from now is a completely separate question altogether.
And most people would say, no way, he's not going to do it. And you say, you know, what are you going to do in September? He's not going to say. He's not going to say what he's going to do later on. But what is going to be interesting is the longer that the speech is, the less clear the message that he's trying to convey. Short, very clear. Pain, we need to get there. We need to get inflation under control. Is inflation going to be the same enemy this year that it was last year? Is inflation at 3% pernicious or acceptable? And I don't think he's going to necessarily weigh in on this, but the tone that he takes will really give a sense of that.
I got this message just moments ago from a Bloomberg subscriber. Thanks for that. It said, come on, Jonathan, get with the program. You're in Wyoming, dress like Michael McKee.
Good morning,
Chairman Powell stepping up to the podium. Here's the chairman of the Federal Reserve.
My man's got the Montclair jacket. Let's go.
My remarks this year will be a bit longer, but the message is the same. It is the Fed's job to bring inflation down to our 2% goal, and we will do so. We have tightened policy significantly over the past year. Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective. Today, I will review our progress so far and discuss the outlook and the uncertainties we face as we pursue our dual mandate goals. I will conclude with a summary of what this means for policy. Given how far we have come, at upcoming meetings, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. The ongoing episode of high inflation initially emerged from a collision between very strong demand and pandemic-constrained supply. By the time the FOMC raised the policy rate in March 2022, it was clear that bringing down inflation would depend on both the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy, which would slow the growth of aggregate demand, allowing supply time to catch up. While these two forces are now working together to bring down inflation, the process still has a long way to go, even with the more favorable recent readings. On a 12-month basis, U.S. total or headline PCE inflation peaked at 7% in June 2022 and declined to 3.3% as of July, following a trajectory roughly in line with global trends. The effects of Russia's war against Ukraine have been a primary driver of the changes in headline inflation around the world since early 2022. Headline inflation is what households and businesses experience most directly, so this decline is very good news. But food and energy prices are influenced by global factors that remain volatile and can provide a misleading signal of where inflation is headed. And in my remaining comments, I will focus on core PCE inflation, which omits the food and energy components. On a 12-month basis, core PCE inflation peaked at 5.4% in February 2022 and declined gradually to 4.3% in July. The lower monthly readings for core inflation in June and July were welcome, but 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. We can't yet know the extent to which these lower readings will continue, or where underlying inflation will settle over coming quarters. 12-month core inflation is still elevated, and there is substantial further ground to cover to get back to price stability. To understand the factors that will likely drive further progress, it is useful to separately examine the three broad components of core PCE inflation: inflation for goods, for housing services, and for all other services, sometimes referred to as non-housing services. Core goods inflation has fallen sharply, particularly for durable goods, as both tighter monetary policy and the slow unwinding of supply and demand dislocations are bringing it down. The motor vehicle sector provides a good illustration. Earlier in the pandemic, demand for vehicles rose sharply, supported by low interest rates, fiscal transfers, curtailed spending on in-person services, and shifts in preference away from using public transportation and from living in cities. But because of a shortage of semiconductors, vehicle supply actually fell. Vehicle prices spiked, and a large pool of pent-up demand emerged. As the pandemic and its effects have waned, production and inventories have grown and supply has improved. At the same time, higher interest rates have weighed on demand. Interest rates on auto loans have nearly doubled since early last year, and customers report feeling the effect of higher rates on affordability. On net, motor vehicle inflation has declined sharply because of the combined effects of these supply and demand factors. Similar dynamics are playing out for core goods inflation overall. As they do, the effects of monetary restraint should show through more fully over time. Core goods prices fell the last 2 months, but on a 12-month basis, core goods inflation remains well above its pre-pandemic level. Sustained progress is needed, and restrictive monetary policy is called for to achieve that progress. In the highly interest-sensitive housing sector, the effects of monetary policy became apparent soon after liftoff. Mortgage rates doubled over the course of 2022, causing housing starts and sales to fall and house price growth to plummet. Growth in market rents soon peaked and then steadily declined. Measured housing services inflation lagged these changes, as is typical, but has recently begun to fall. This inflation metric reflects rents paid by all tenants, as well as estimates of the equivalent rents that could be earned from homes that are owner-occupied. Because leases turn over slowly, it takes time for a decline in market rent growth to work its way into the overall inflation measure. The market rent slowdown has only recently begun to show through to that measure. The slowing growth in rents for new leases over roughly the past year can be thought of as in the pipeline and will affect measured housing services inflation over the coming year. Going forward, if market rent growth settles near pre-pandemic levels, housing services inflation should decline toward its pre-pandemic level as well. And we will continue to watch the market rent data closely for a signal of the upside and downside risks to housing services inflation. The final category, non-housing services, accounts for over half of the core PCE index and includes a broad range of services, such as healthcare, food services, transportation, and accommodations. 12-month inflation in this sector has moved sideways since liftoff. Inflation measured over the past 3 and 6 months has declined, however, which is encouraging. Part of the reason for the modest decline of non-housing services inflation so far is that many of these services were less affected by global supply chain bottlenecks and are generally thought to be less interest sensitive than other sectors, such as housing or durable goods. Production of these services is also relatively labor intensive, and the labor market remains tight. Given the size of this sector, some further progress here will be essential in restoring price stability. Over time, restrictive monetary policy will help bring aggregate supply and demand back into better balance, reducing inflationary pressures in this key sector. Turning then to the outlook, although further unwinding of pandemic-related distortions, 150 basis points, and longer-term real yields are higher as well by nearly 150 basis points. Beyond changes in interest rates, bank lending standards have tightened and loan growth has slowed sharply. Such a tightening of broad financial conditions typically contributes to a slowing in the growth of economic activity, and there is evidence of that in this cycle as well. For example, Growth in industrial production has slowed, and the amount spent on residential investment has declined in each of the past 5 quarters. But we are attentive to signs that the economy may not be cooling as expected. So far this year, GDP growth has come in above expectations and above its longer-run trend. And recent readings on consumer spending have been especially robust. In addition, after decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy. The rebalancing of the labor market has continued over the past year, but remains incomplete. Labor supply has improved, driven by stronger participation among workers aged 25 to 54, and by an increase in immigration back toward pre-pandemic levels. Indeed, the labor force participation rate of women in their prime working years reached an all-time high in June. Demand for labor has moderated as well. Job openings remain high but are trending lower. Payroll job growth has slowed significantly. Total hours worked has been flat over the past 6 months, and the average work week has declined to the lower end of its pre-pandemic range, reflecting a gradual normalization in labor market conditions. This rebalancing has eased wage pressures. Wage growth across a range of measures continues to slow, albeit gradually. While nominal wage growth must ultimately slow to a rate that is consistent with 2% inflation, what matters for households is real wage growth. Even as nominal wage growth has slowed, real wage growth has been increasing as inflation has fallen. We expect this labor market rebalancing to continue. Evidence that the tightness in the labor market is no longer easing could also call for a monetary policy response. Turning to the path forward. 2% is and will remain our inflation target. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. It is challenging, of course, to know in real time when such a stance has been achieved. There are some challenges that are common to all tightening cycles. For example, real interest rates are now positive and well above mainstream estimates of the neutral policy rate. We see the current stance of policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint. That assessment is further complicated by uncertainty about the duration of the lags with which monetary tightening affects economic activity and especially inflation. Since the symposium a year ago, the committee has raised the policy rate by 300 basis points, including 100 basis points over the past 7 months. And we have substantially reduced the size of our securities holdings. The wide range of estimates of these lags suggests that there may be significant further drag in the pipeline. Beyond these traditional sources of policy uncertainty, the supply and demand dislocations unique to this cycle raise further complications through their effects on inflation and labor market dynamics. For example, so far, job openings have declined substantially without increasing unemployment, a highly welcome but historically unusual result that appears to reflect large excess demand for labor. In addition, there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades. These changing dynamics may or may not persist, and this uncertainty underscores the need for agile policymaking. These uncertainties, both old and new, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. As is often the case, we are navigating by the stars under cloudy skies. In such circumstances, risk management considerations are critical. At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlook and risks. Based on this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data. Restoring price stability is essential to achieving both sides of our dual mandate. We will need price stability to achieve a sustained period of strong labor market conditions that benefit all. And we will keep at it until the job is done. Thank you.
We will keep at it until the job is done. Chairman Powell, 12 months later, after promising pain, without much sign of it, 300 basis points later, the goal is still the same. 2% is and will remain our inflation target. The price action off the back of this address in Jackson Hole, Wyoming, shaping up as follows on the S&P 500. Equities elevated, and it stays that way. The S&P up just a little bit on the S&P 500 right now. If we can run through the boards, we get equities up, and then we can get bonds, and we'll do it piece by piece and start with stocks. Stocks are still positive on the S&P 500. Yields look like this, Tom. They're lower by 3 basis points on a 10-year, 420.39.
Dollar comes in. Let's go right to it, John. Euro, a little bit of dollar weakness with the euro 107 earlier, and come out to a 108.04 maybe with a little bit of a euro lift here.
Knee-jerk reaction, Tom, but I would be hesitant to define this speech based on the intraday price action on the S&P 500 in the bond market. That was a Federal Reserve chairman effectively telling us all, Lisa, that the job is not done, and if we need to do more, we'll do more.
This was a Fed chair saying, stop talking about 3% as the new normal for inflation. 2% is what we're going to get down to. We are not going to stop until we get there. The long and variable lags are long, but they are going to come to fruition. He talked about how there is tightening that's going to hurt. But to me, that is the takeaway. They are not entertaining a 3% target for inflation, despite a lot of people saying that maybe that's what they ought to do.
A perfect Jackson Hole morning, and with the food spread that we've got laid out in support of our staff here, the crows descend, and while the chairman was speaking, it was the Jackson Hole crows. All the hawks are indoors. Because my first take from the first sentence of the speech is it was a hawkish speech.
If the labour market is not easing, monetary policy needs to respond. How much of a sign are you seeing that this labour market is easing?
I'll let McKee and the others I'll let Dr. Laird and Mike McKee judge this. I'm not going to judge it, but I'm just going to say all the hawks were inside listening this morning.
Well, two things. One, either the market doesn't believe that they're actually hawkish and just thinks that they're trying to job them down. And the fact that he didn't come out and say we're going to hike again is basically an all clear signal. And maybe that's what he could take the market reaction. And number two, are they really convicted to go through with this? Yes, they're going to get down to 2%, but if it takes to 2035, does it matter? Right? I mean, in other words, how imprudent is it to bring it down quickly?
Our first math of the morning here, 8:19 a.m. Mountain Time, is 2% 2.0%? Or is it 2.4? Or is it 1.9 rounded up? I don't know.
The former Fed Vice Chair, Rich Clarida, in a secular...
Guys, look at where they're sitting. Look at where I'm sitting.
I think that might be something they tolerate. Yeah. Tom, at the end of the day, if they're still shooting for 2%, except 2% is out there in 2025, that's a shift, isn't it?
Yeah.
Isn't that tolerating above target inflation for longer?
Yeah, but there's a lot of data to come before we get to that point. I think the...
All right, guys, look, here's the thing. The reason this is a good speech is you've got to have context of what's happened historically. If you go back to the Paul Volcker period, you had a period where inflation was out of control. He came out, he raised rates aggressively, and he couldn't break the back of inflation. He ended up having entrenched inflation, which finally the economy kind of just learned to live with. Now, what's rejoicing about what Jerome Powell is saying? I know it's hard for us as investors because we just want him to cut and we just want him to say, oh, no more rate hikes and on we go. But longer term, this is really positive, is that he is saying, I'm going to finish inflation off. I'm going to get it back to this 2% target. I'm not going to accept 3% or 3.5%. Because what he could have done, there was another version of this meeting, right? When we were sat here this time last year, there's another version of this meeting where he could have come out and said, guys, we've gone from 8.2% to 3.2. We may be around here at 3.2, but you know, it's stubborn and it's going to be sticky and it might be here for a while. But we've not got that, right? We've got a Jerome Powell that has not damaged the economy, has not driven us into a devastating recession, has managed to bring inflation down from those 8.2% level. Yes, he's got some work to do, but he's going to continue, right? And therefore, when you look at it with a sober mindset, not with a, oh, pump it mindset, you look at it and going, hang on, this is good, right? Because I want everybody to zoom out and remember that the people who made money, made so in when the economy was healthy, right? The US economy being healthy, grows the wealth for a lot of people across the globe, right? And US, of course, stocks will go up, crypto will go up, asset classes will go up, watch values go up, right? All kinds of investments go up, real estate goes up, right? It goes up. So it's in our best interest for them to continue to get out of this mess, right? And to bring inflation down to the proper 2% level, and then finally head into a printing phase again, where they can start loosening monetary policy and then go back to loose monetary policy with the zero interest rates, right? That's where ultimately everybody's going to make money in their stocks and all their other investments. So this is a good meeting. It's not a, the speedful answer we want, but it's a good thing. It's saying, he's going to keep going. He's going to get us to 2%. And he's going to finish it off, whatever it takes. So you can see here straight away markets already were adjusting down here. Now 20% of the market has now changed their mind. They're expecting a pause. Remember, the 90+% was expecting a pause. Now 20% are expecting 25 basis point rate hike. This 20% is pricing in one more rate hike, okay? So look, whether it's one more rate hike, whether it's two more rate hikes, the reality is what we need to focus on is we've just been through one of the fastest rate hiking cycles we've ever seen, right? We've just been through that. And you guys managed to DCA, you managed to navigate your way through, and that is no mean feat. That is no mean feat. If you go to the generation above us, they had amazing times. They built wealth during amazing periods with low interest rates, like really easy to get on the property ladder, really easy to do everything. The S&P was up and to the right. We've just had a tightening cycle, which is tough, right? You have these periods every so often in the monetary cycle. And now we get to come into the final innings of that, and soon the better times will come, right? Where they're loosening, they start cutting, and eventually get to those zero interest rates where hopefully we'll hold there for a while. So look, we've got to focus on the positives. That's what I take away from what he was saying. Let me know in the comments, guys, how are you feeling about it? What were you looking for? Were you hoping for a more immediate dump or pump? For me, that's a good meeting. It shows that Jerome Powell's in control, and that's ultimately what we want. Justin says, I have the feeling this year will go on till 2030, till the Great Reset. Ultimate Chicken, classic Jerome. He's always late to the inflation 2021. He's going to be late to cut rates to, yeah. And that's the other side of the argument, right? So we've got, and it's fair to cover that off, Ultimate Chicken, as well. Like, you guys know over the last couple of rate hikes, I've been nervous. I've been nervous at the rate hikes because if you remember, if we go back to earlier this year, we had major regional banks collapsing, right? Major regional banks collapsing at that interest rates because the face value of their bonds had to be written down, right? So they were technically insolvent. That was Silicon Valley Bank, Signature Bank. You cannot lead me to believe there aren't other US major regional banks in the area who are also struggling. Each 25 basis point increase we've had, plus the lag of staying there for longer, is going to be affecting a lot of businesses out there. And I think it's that lag that we don't have the data for, and we're having to trust Jerome Powell because he gets access to better data than us to know what he's doing. And if, like you said there, Ultimate Chicken, if he's late to that, if he messes up on the rotating out and he cuts one too many or two too many and leaves it for too long, that's where the recession can come in. That's where you can get stagflation. That's where you can now really start to damage your economy, create a lot of unemployment. Because right now he's looking and going, hang on, inflation is coming down. I've not damaged the economy. The jobs aren't looking too bad. Jobs figures are looking good. Unemployment doesn't look too bad. Right? I'm doing a good job. Let me just finish this off while I've got the impetus, right? Which I understand. He wants to finish off inflation while he's got this chance. Because if he doesn't, maybe the US would have to live with 3.5% kind of inflation for the next period of time, next decade. He doesn't want that, right? I want to listen to this guy. This guy's good, Mohammed Al-Arian. Let's listen to him.
Yeah, about moving stars, all the structural changes that are going on domestically and internationally. And that just adds to the topic that the three of you have been talking, that it's a very complex world out there, and the Fed has to navigate a lot of moving pieces.
Mohammed, one conversation you and I have had over the last several weeks, the last several months for that matter, people are having this discussion here as well. Are we, from your standpoint, in your opinion, sufficiently restrictive?
John, this goes immediately to what is the right inflation target. If the right inflation target is 2% and they want to get there in a credible period of time, then we are not sufficiently restrictive. If the right inflation target, as you've heard many people say, including Adam Posen today, is above 2%, given all the structural changes,
but Jerome Powell didn't say
we're going to get there is not by announcing the new target, but by following a shadow target, and then once we see it stable, adopting it. I think that's the most likely outcome, by the way. Then we are sufficiently restrictive.
That makes sense.
Mohammed, does it...
Does that make sense, guys? So what they're saying, he's going to say is 2%. Maybe it's going to get down to 2.4, 2.5, and then he's just going to accept it. Then he's going to accept that that's where
we're not there yet. Stop declaring victory. There's a lot more down the pike. Everybody else sounds like things are going really well, and the Fed policy is achieving exactly what it sought to.
So I don't think it's everybody else, but most people are, especially in the marketplace. Not so the economists. You have Larry Summers, for example, reminding us this morning that if you look at the 70s inflation cycle, this one looks very similar. He has the two graphs up, and he's sort of warning implicitly that we may see a pickup in inflation. So I think the marketplace is much more complacent than the economists are. The economists recognize that there are many moving pieces, whereas the marketplace thinks that we've gotten to a new equilibrium, and from here is going to be cuts next year. That remains to be seen.
Do you think, Mohammed, that it's important for the Fed to get ahead of a potential resurgence in inflation? Or do you think that Jay Powell's approach of watching the stars and seeing what they are will be sufficient to curtail some sort of more embedded inflation?
It's hard, Lisa, because as you know, they have not, like past Feds, opted for a strategic view of inflation, nor do they have a functional monetary policy framework. So they've become highly data dependent, which means that they are using instruments with lags on backward-looking data. So they are in a bit of a tough situation. They're going to remain data dependent. So I don't think he knows what they will do in September. He's going to wait to see what the jobs report is. He's going to wait for the CPI numbers, and then they're going to decide what to do. But this is the irony: it's a highly dependent, data-dependent Fed using instruments that act with a lag.
On radio and television here from Jackson Hole, Mohammed El-Arian with us this morning. And as Dr. El-Arian speaks, John, markets are moving here. I just noticed the rebound in dollar back above DXY at 104 to Global Wall Street. That's important.
Break of 108 on the euro as well, Tom, against the dollar right now, about 107.95.
Just Chris had an interesting comment there. He goes, rates will stay roughly the same in the US until the new election run starts early next year. Yes. I mean, leading up to the elections, that's such a natural place for Biden to have a word with Jerome Powell and say, loosen now, right? Get a crazy pump in the markets, put a bit of extra money in people's pockets, let them feel good again, close enough to the election that they remember that, oh, look, you know, this was done under this administration, right? So that is one, definitely, monetary policy is used as an election tool. We have to, obviously, there's not a political channel here. We don't cover off from politics perspective, but from a financial perspective, it definitely is used as a political tool.
I heard it from you, I heard it from John Lipsky and others. The simplicity we're all begging for is T decisions. You are known for this. This is a Jackson Hole devoid of T decisions. How do our viewers and listeners handle the complexity now and to come?
Tom, I think the most important thing to understand is that we have left the world of insufficient demand and we are now in a world of insufficient supply. And there's many reasons for that. It's a world that's not going to go away anytime soon. It's not pandemic issues that are fully reversible quickly. There are longer term issues going on. Changed globalization, supply chain management, the functioning of the labor market, and the list goes on. So we are now in a different world of supply side constraints. And that world will mean that countries will become more inwardly looking, which we've seen already. And it also means that policy has to adjust to that. Now, put on top of that the layer of industrial policy as we embark more meaningfully on a green transition. And it's all about the supply side, Tom. And that's where monetary policy is really challenged, because it acts on the demand side.
We're thrilled, Mohammed, to have Dr. Georgieva with us, and then you and Christine Lagarde with us later. And the heart of the matter is, are we beyond the supply shocks of this pandemic? Where are we on?
All right, guys, let's wrap that up there. Let's do a round off of where we're at in the charts now. Bitcoin here falling 0.5% here on the day. Again, where we're at, right? In this range bound, can't really seem to get past the 26.8 level. Can't seem to fall below, much below 25.6. A range bound here between this kind of $1,000 range here on Bitcoin. More importantly, which I want you guys to pay attention to, is the 4-hourly chart. Look at the 4-hourly chart. Bring out your EMA ribbon. Again, if you don't know how to do any of this stuff, ijaz.uk/TA. Take advantage of my TA education program and learn what took me over a decade to learn in just weeks. Just watch the course and download everything from my brain instead of all this trial and error, and you'll be making profits much sooner. So you can see here running into the EMA ribbon, right? Watch out for this. We ran here, got rejected down. It might try going again, and again I expect it to get rejected down. I do feel like that 25k level seems kind of inevitable, right? Like even if we gain our 4-hourly EMA ribbon, then you look at the daily EMA ribbon, and it's miles away. The daily EMA ribbon starts here at 27.5. So a lot of work to do here for Bitcoin. Really, you know, we're talking about pumping up all the way here, 28.4, 28.5 to regain this one, right? To regain this EMA ribbon. So a lot of work to do here for Bitcoin. Not going to be easy. May well take a lot of sideways consolidation. The main question is, where is it going to hold support? Where is it going to hold powerful support? Is 26 enough, right? 26 would be, of course, a higher low to where we touch down to 25 here in June. So it's still a slight upward trend, if anything, right? And the best way to look at it would be from this channel here. Let me just show you this. This is probably the best way I'm looking at the markets right now, is using this chart. Right, if you're using this chart, you can see here higher low, and you're going to get a slightly higher low there as well. So you're kind of uptrending, right, just across there, just ever so slightly. Now, of course, if you look at this, this is where our resistance is being faced. So the big worry right now is this M pattern. If we lose the purple line there, we could be facing a big move to the downside, because you've got this M pattern, this double top formation, which normally breaks you to the downside. If we start losing this purple line, I'm expecting a big powerful move down, and it's going to be hard to stop us getting down to 20, in my opinion. That's going to be quite hard. Now, of course, this level of support 25 is very, very important, and Bitcoin needs to be able to hold that and bounce. If it can't bounce from where we are now, then it can come down here and bounce from there. But again, like I said, a lot of work to do, right? If I come up here to the weekly, we're below our weekly EMA ribbon. I don't want anybody to underestimate the fact that this is not easy. It's not easy to come straight back in, regain the EMA ribbon. You've got to close right there above 27.8 to get back into the EMA ribbon and then start working our way to the upside. So lots to play for here. Jerome Powell, fortunately, hasn't rugged us just yet. I think markets, hopefully, will take it with a sobering reality that, look, he wants to carry on getting the work done. The risk that the market's going to be worried about is that he over tightens, right? He gets too excited about getting inflation down to 2% exactly, that he keeps doing 25 basis points. And one of those 25 basis points could be the straw that breaks the camel's back. Just suddenly, unemployment rises, joblessness everywhere, labor market broken, stagflation, right? And then drive us into a painful recession. That's what markets are going to be worried about. Which companies are in trouble right now? Which banks are in trouble right now with, 5% Fed funds rate? And if you're going to hike by another 2 rate hikes, maybe 25 basis points, another 25 basis points, what damage could you be doing with the lag effect? Because ultimately, that's the big problem right now. Jerome Powell is steering this economy, right? Steering this economy like an aeroplane, trying to get this soft landing. But he's doing it with his instruments, his altitude, right? His speed indicators. But they're all on a lag. They're giving him 30-second old data. How are you supposed to land this aeroplane, right? So that's the problem with monetary policy right now. And that's why ultimately we never truly see pivots until we see pain. When we see that pain, that's when he started rate hiking. When we see the pain through too many rate hikes, that's probably going to be where he cuts. So hopefully you found this useful, guys. If you appreciate this type of live content with the content that matters, not just saying, oh, Bitcoin going to zero, Bitcoin going to the moon. Smash all the likes, make sure you subscribe, support this channel. There will be a second channel with other business related